Welcome back to CMA USA Exam Coach. I hope you watched our previous episode where we discussed the cash inflows and outflows of an investment. This is a very important foundation because understanding the cash flow pattern is the key to analyzing any project. Today we are starting with the very first tool of capital investment budgeting, which is the traditional payback method. This method is one of the simplest techniques used in evaluating projects, and it will help us understand how quickly an investment can recover its initial cost. So let's get started.
As we discussed in the previous episode, we have to cover all the 5 major tools used in capital budgeting. These tools help us evaluate whether an investment is worthwhile or not. Today, we are starting with the very first tool, which is the traditional payback method. In the coming episodes, we will also discuss the other 4 tools. These are the discounted payback method, the net present value, also called NPV, the internal rate of return, also called IRR, and finally, the accounting rate of return, also known as ARR. Each of these tools has its own way of analyzing an investment, and by the end of this series, you will have a complete picture of how managers make capital budgeting decisions. So, what is the traditional payback period? The payback period is simply the time it takes for a project to recover the money that was originally invested. We can also say it is the number of years required for the cumulative cash inflows from the project to become equal to the initial outflow. Now, this method is considered one of the oldest and most straightforward techniques of capital budgeting. The logic is very simple. If a project can return the invested amount quickly, then it is considered safer because the risk of losing money reduces once the investment is recovered. But it is important to note that in the traditional payback method, we are not concerned with the present value of money. We just take the cash inflows at their actual amounts and keep adding them up year after year until they match the original investment. Once they are equal, the number of years taken is called the payback period. So, in summary, the payback period gives us a clear measure of how fast an investment can return our funds. It focuses only on liquidity and risk in the early years, but it does not tell us anything about profitability beyond the recovery point. To understand this more clearly, let us take a very simple example. Suppose we have invested $100,000 in a project. Every year, the project generates a cash inflow of $20,000. If we keep receiving $20,000 each year, then in 5 years we will collect a total of $100,000. That means, by the end of the 5th year, we have fully recovered our investment. So here, the payback period is 5 years. But it does not stop there. After the 5th year, the project may still continue to generate cash inflows. All those additional inflows after the payback period are considered as extra returns or profit from the investment. This simple example shows how the traditional payback method works. It only tells us how long it takes to recover the original money invested, without considering the extra inflows or the time value of money. From the simple example we just discussed, we can also derive the formula for calculating the payback period when the project generates equal annual cash inflows. The formula is very straightforward. Payback period equals to initial investment divided by annual cash inflows. So, we are simply dividing the total amount invested by the uniform cash inflow received each year. The result tells us the number of years it will take to recover the investment. This formula works only in cases where the annual cash inflows are equal or uniform. If the inflows are not equal, then we cannot use this direct formula. We will need to add the inflows year by year until the investment is recovered. That part we will see in the next example. Let us now look at another example. A company has acquired a new machine costing $250,000. This machine is expected to reduce the annual operating cost by $80,000. The machine will be depreciated over 5 years under the straight-line method, and the tax rate is 40%. We are asked to calculate the payback period. First, let us calculate the after-tax profit. The savings from operating cost are $80,000. After applying tax at 40%, the actual savings, or profit, come down to $48,000. Next, we need to include the depreciation tax shield. The depreciation per year is $250,000 divided by 5 years, which equals $50,000. Applying the 40% tax rate, the depreciation tax shield becomes $20,000. So, the total annual cash inflow is the sum of both. The after-tax profit of $48,000 plus the depreciation tax shield of $20,000, which gives us $68,000 per year. Now we can apply the payback period formula. Payback period equals initial investment divided by annual cash inflows. That is $250,000 divided by $68,000, which equals approximately 3.67 years. This means the company will recover its investment in about 3 years and 8 months. So far, all the examples we discussed assumed that the project generates equal annual cash inflows. In such cases, we can directly use the payback period formula. But in real life, cash inflows are not always uniform. For example, in our previous episode, we worked on the ABC Company case. Let us recall the figures there. In year 1, the total inflow was $86,000. In year 2, after considering the additional investment, the net inflow dropped to $19,250. In year 3, after accounting for the extra working capital, the inflow became $66,250. In year 4, with only the regular operations and depreciation shield, the inflow was $71,000. And finally, in year 5, with operating inflow plus recovery of working capital and disposal proceeds, the inflow rose to $154,000. Now here, because the inflows are not equal, we cannot simply divide the investment by one single annual figure. Instead, we must add the inflows year by year until the cumulative inflows become equal to the original investment. The year in which this happens is the payback period. This approach is slightly more time-consuming, but it reflects practical situations where cash flows vary from year to year. Let's go through the steps to calculate the payback period. First, we start with the initial outflow. At year 0, we have the initial investment along with the working capital. When we add these together, the total cash outflow comes to $235,000. Next, we look at the inflows for each year. In year 1, the inflow is $86,000. In year 2, after accounting for additional investment and adjustments, the inflow is $19,250. Moving to year 3, the inflow rises to $66,250. In year 4, without any additional investments, the inflow is $71,000. Finally, in year 5, we have the last year of operations, plus the recovery of working capital and the proceeds from the disposal of the machine, giving us a total inflow of $155,000. Now let's calculate the cumulative payback period. We start with the total initial investment of $235,000. In year 1, we receive an inflow of $86,000. To find the remaining investment to recover, we subtract this inflow from the total investment, which gives $149,000 still to recover. In year 2, the inflow is $19,250. Deduct it from the year 1 recoverable amount of $149,000 gives us $129,750 to recover as of year 2. In year 3, the inflow is $66,250. Deduct it from the year 2 recoverable amount. This gives us the year 3 recoverable amount of $63,500. In year 4, the inflow is $71,000, which is enough to fully recover the remaining $63,500. By calculating the fraction of the year needed to recover this remaining amount, we find that the payback period occurs during year 4. So, the traditional payback period for this investment is approximately 3.9 years. This shows us how long it takes for the project to fully recover the initial investment using the actual inflows each year. This is how we calculate the payback period when the cash inflows are not equal. By taking each year's inflow, adjusting for any additional investments or changes in working capital, and tracking the cumulative recovery, we can see exactly how long it takes to recover the total initial investment. In our example, even with varying inflows, we found that the investment is fully recovered in about 3.9 years. This method helps us understand the timing of cash recovery and the risk associated with different cash flow patterns.
Thank you for watching this episode. Make sure to practice questions and understand how the traditional payback method works in both cases, when cash inflows are equal and when they are unequal. In the next episode, we will move on to discuss the discounted payback method. See you in the next episode.